What's up, everybody? This is Sungko, the Korean bro, and today is 2023, July 3rd. Let's see, okay? Okay. If, hmm. Is Etsy stock a buy? Better artificial intelligence, Adobe or Nvidia? Three stocks that can double again the second half of 2023. And two unstoppable stocks that could turn $200,000 into $1 million by 2033. Losing ground on this key metric. Okay, first things first. C hasn't gained many. Okay. Okay. It's Etsy stock or buy. Etsy hasn't gained many new buyers following its pandemic surge in the past year. Engagement remains strong, but investors might want to watch for more improvements. Okay. E-commerce platform providers struggling on the growth front. Wall Street pros haven't bought into the Etsy rebound story yet. The e-commerce platforms stock, which has seen huge gains during the pandemic, is down sharply so far in 2023, even as the tech having also composite has soared. There are some good reasons for that underperformance, including the fact that Etsy sales volumes have barely budged over the last few quarters. Profit margins are much lower than they were 2 years ago, too. Yet the platform is growing and adds it has a good shot at boosting annual earnings with help from rising buyer fees against that mixed backdrop. Let's take a fresh look at whether the stock is a buy today. Reasons to buy. Investors don't have to stretch to see reasons for optimism around this business. Sure has reported another quarter of declining sales volumes the first quarter, but its marketplace revenue is still far higher than it was before the pandemic. And Etsy returned to modest growth in its buyers pool this past quarter, with its 1% uptick standing out compared to eBay's 7% decline. Etsy's financial trends are encouraging too. It collects fees of over 20% on sales that merchants make on its platform, and profits are also padded by its growing advertising business. It collects fees over 20% on sales that merchants make on its platform. 1-year-old revenue to rise 11% last quarter despite slightly weaker sales volumes. On the other hand, Edge reported weak expansion in its buyer pool this past quarter after that key metric declined in every quarter since late 2021. It's hard to see a path towards strong growth in this business without a more aggressive rebound on this front. That these profit margins are moving in the wrong direction. A 14% spike in operating expenses last quarter helped push net profit down to 12% of sales from 15% a year ago. eBay enjoys a far higher margin of more than 22% of sales. In contrast, the bullish thesis for Adi stock sees the company eventually matching or surpassing its peers on profitability. To date, there is a little evidence to suggest he can achieve this ambitious goal. The risks seem to outweigh the benefits for this growth stock right now. Active potential is there. The engagement is much stronger on the platform than it was in the past pre-pandemic days. But its long streak of weak sales trends plus declining profitability translate into significant risk that operating trends will remain unimpressive. There's no question that the stock's valuation is much more reasonable today. Investors can buy Etsy for roughly 4 times annual sales, down from a recent high of over 15, yet the stock is still valued at a premium compared to eBay. And there's a chance that the valuation will decline further if there's continued delay in management's rebound hopes. There will be more clarity around the business when Etsy announces quarter second results in late July. In the meantime, investors might want to simply watch this stock until they see signs of accelerating sales growth, trends, and stable profit margins. Adobe. Artificial intelligence could unlock new growth opportunities for investors. Adobe and Nvidia are operating at the forefront of the AI revolution. Although both companies are poised to benefit from AI, Adobe screens as the better buy right now. But let's look at Nvidia, okay? Nvidia is one of the most valuable companies in the world. With a market capitalization of over $1 trillion, the company rewards its shareholders with a modest dividend of 0.4% per year, as well as a generous stock buyback program. In 2023, Nvidia's management is authorized to buy back $50 million worth of its own stock. The company also has plenty of room to increase its dividend, as it only paid out 8.33% of its earnings to shareholders over the prior 12 months. However, management seems more interested in reinvesting its profit into growth. Although Nvidia is leader in AI, it faced some challenges in its 2024 fiscal first quarter. During the 3 month period, revenue dropped by 13% related to the same period a year ago. This double digit revenue decline was mainly due to lower demand for its gaming and professional visualization products. On the bright side, Nvidia's revenue from data center and automotive segments grew by a healthy 14% and 114% respectively. Okay. Analysts expect Nvidia to quickly bounce back from this disappointing fiscal first quarter. For the rest of its fiscal 2024, the company is projected to grow its annual revenue by a noteworthy 58.2%, and by another 27.4% in fiscal year 2025. NVIDIA's exceptional growth prospects reflect the rising demand for AI based solutions across a wide range of industries. The downside is that the Nvidia stock price likely already reflects its impressive growth potential. The company's shares trade at a whopping 55.2 times forward earnings, which is much higher than the average of its or large cap tech peers and Adobe. Duolingo. Autonomous driving could be today's financial opportunity ever. Okay. And disrupting an age-old industry. Ambitious goal to change the industry. It has an expanding product portfolio that already includes renters insurance, homeowners insurance, life insurance, pet insurance, and car insurance. Disrupting such an enormous industry makes for a volatile journey. Lemonade stock price is down 90% from its all-time high as investors have shone on profitable companies over the last couple of years amid tough economic conditions. So recovering even half of that ground would almost be enough for a five-fold gain. But Lemonade has even more potential in the long run. The company uses AI to interact with customers. The chatbots can write insurance quotes in 90 seconds and pay claims in under 3 minutes without human intervention. Plus, Lemonade continues to release more advanced models behind the scenes to help price premiums more accurately and target the most lucrative products and geographic markets to maximize its revenue. Speaking of which, Lemonade generated just $67 million of revenue in 2019, but it grew at a compound annual rate of 56% to top $256 million in 2022. That isn't much of a track record given the company is still so young, but it's much a faster growth rate than the 17.5% annual rate to return it needs to stand. It starts surging fivefold between now and 2033. Plus, there are signs Lemonade's growth is actually accelerating. In the first quarter of 2023, revenue surged 115% year over year, which was significantly above trend. Plus, the company expects a similar result in the current quarter. The market for car insurance in the US alone was worth $327 billion last year. Considering Lemonade's total in-force premium is just $653 million across all products right now, it has enormous runway for growth, and it shouldn't be surprising that its revenue increases at a faster rate as the company scales. Hmm. Oracle. Mm, okay, let's read it one by one. First, we have Roku. Over and over and over and over. Get the inside scoop on how you can benefit from the market's overreactions to inflation and its side effects. Stock market doldrums of 2022 were leaving infamy. The S&P 500 index fell 19.4% last year, making it the seventh worst market year since 1929. But the worst market years have often been followed by impressive gains in the next year, and 2023 is shaping up to follow that pattern. Luckily, you still have the time to pick up some top quality stock at a generous discount before the next bull run. In particular, you should take a second look at media streaming technology expert Roku, e-commerce giant Amazon, and freelance marketplace operator Fever International. While the getting is good, Roku, don't get me wrong. I understand why market makers slap a rebate flavor, a price tag on stock as the inflation crisis played out. Roku's high octagon growth has slowed down in recent quarters, and the all important digital advertising market is still far below room temperature. All of that makes perfect sense, but Roku's market pendulum swung too far in the other direction. The stock deserves a modest correction last year, not the 92% meltdown recorded near the end of 2022. Stock gained 57% in the first quarter, first half of 2023, but still sits 87% below the all-time highs of 2021. Again, I understand how you could make an argument for this radical price cut if there were something seriously wrong with Roku's business model or future prospects. He essentially created this market selling this first streaming boxes for Netflix video streams back when that content was just a free add-on for Netflix DVD mailer subscribers. Okay, so they're the first author. That's what it is. Okay. The company has been fine-tuning its user platform ever since, while also collecting valuable viewer data and crafting its own content publishing plans. If Roku isn't a top solution for streaming systems on a global level in 5 years, I'll end my Roku stick. Okay. I could go into excruciating detail on how Roku's neutral viewing platform serves every content service and why both new and established streaming channels essentially have to support the Roku platform or miss out on millions of potential viewers. I could spend hours on the cord cutting, train pointing to massive long term growth for the streaming market. When you don't want to get me started on the temporary nature of the advertising slowdown. Cord cutting trend. I get it. Neutral viewing platform serves every content service and why both the new and established streaming channels essentially have to support the Roku platform. Okay. Then you don't want to get me started on the temporary nature of the advertising slowdown on our case of revenue shifting deeper into the digital world over time. But you could follow the links I just gave you if you want that kind of detail. Here just say that Roku's business prospect look excellent. Grabbing a few shares at this bargain bin prices should set you up for tremendous gains as the streaming market matures. If Fiber International, many investors saw Fiber as a huge beneficiary of the lockdowns and safe at home policies of the early coronavirus pandemic. Lots of people found themselves with plenty of extra time on their hands, often equipped with newly upgraded computer systems and network connections, also eager to grab whatever extra income they could find. So fiber services gained traction, revenue soared, the stock skyrocketed, but the gravy train stopped as soon as effective COVID-19 vaccines became widely available. Largely forgotten as soon as people could get back to the office again. So Fiverr started out trade near an all-time low, 93% below the peaks of early 2021. And I think that's a big mistake. You see, Fiverr did not run into a brick wall in 2021. Instead, sales soared 57% higher that year and added another 13% jump on top of that larger revenue platform in 2022. That is indeed a dramatic slowdown. But not for a lack of interest in freelance services. You may have noticed that there's an inflation-based economic crisis to deal with. which makes many businesses hold on to their budgetary pulse strings with a tight grip. Fiverr is quite exposed to that pressure given how quickly its main clientele is small to medium business adjust to economic news. We felt macro ahead of everybody else because small businesses are very similar to consumers, so you feel it very, very quickly. Said at an industry conference in May, bigger ships take longer to turn. They feel macro slightly slower. They have committees decide that they want to cut back on expenses and so on. Smaller businesses don't have that. They just see the wrong headline in the newspaper and they're done. They're playing defense instead of offense. On the other side of the same coin, Fiverr should enjoy the economic recovery earlier and more dramatically than companies serving enterprise class clients. So the rumors of Fiverr's death are exaggerated, and the company still just biding its time until the market recovery gets going. Mind you, even the deepest, darkest downturn, still all the Fiverr's sales should grow at a double-digit percentage rate. As a leading gig economy name, this little company is going places in the long hour. You should consider grabbing a couple of shares before the next growth spurts. Walgreens, Salesforce. Okay, Salesforce. Let's look at Salesforce. Salesforce.com. Okay, during a month when the tech stocks generally moved higher, Salesforce was moving in the opposite direction after Wall Street blew off the company's first quarter earnings report, even as it topped the analyst consensus and raised its earnings guidance for the full year. Revenue in the first quarter rose 11% to $8.25 billion, which topped estimate at $18.18 billion. Adjusted earnings per share of 1.69 were up from $0.98 in the quarter a year ago and half of the consensus at $1.61. The company has been focused on cost cutting after round of layoffs and a move to shrink its real estate footprint. Looking ahead, the company maintains its full year guidance of $34.5 billion to $34.7 billion, representing 10% growth, and raised its full year adjusted EPS guidance to a range of $7.41 to $7.43. Later in the month, the company held an AI Day announcing an artificial intelligence cloud with a suite of tools that provide generative AI experience across a range of applications. The event sparked some positive analyst chatter on the stock. Though Salesforce revenue growth has slowed to an all-time low, the company is committed to controlling costs and improving margins. Much of the tech sector has seen top-line growth slow, and if Salesforce can re-accelerate its growth rate, the stock should be a winner from here. Uh, Mercado Libre. strong growth on top line, bottom line. It is dominant position handmade vintage e-commerce. The Latin American e-commerce marketplace and digital payments platform have continued to deliver strong growth results. The first quarter revenue was up 58% to $3 billion, and profits soared as well, with earnings per share jumping from $1.30 to $3.97. Mercado Libre also benefits from a network of complementary business that gives it a competitive advantage. Those include its e-commerce marketplace, its digital payment platform, Mercado Pago, its logistics service Mercado Envios, and the financing arm Mercado Credito. Those businesses have helped make Mercado Libre the e-commerce leader in Latin America and create the barriers to entry for other companies. At the same time, the company has been able to layer hard margin business over what was originally a direct selling of e-commerce operation. Those include its third-party marketplace digital payment business, lending business, its fast-growing advertising business, which leverages the company's position at the bottoms of the marketing funnel, making it attractive to the business that sell on the platform. While profit margin expanding and revenue growth continuing to be strong, Mercado Libre has a bright future, especially as Latin America's middle class keeps expanding. Okay, Wall Street thinks this stock could rise 30% this year. Okay. Mercado Libre is seeing greater usage of its products. Mercado Libre stock hasn't been this cheap in over a decade. Products are growing in popularity, but if you look at the company's clear 37% increase is just the beginning. Mercado Libre is poised for massive upside. Investors should strongly consider adding this stock to their portfolio before another run up occurs. Read on to find why. Growing in popularity. In Latin America, one company reigns supreme in the e-commerce space. Mercado Libre has multiple products spanning on online store, shipping, logistics, digital payments, and consumer credit. With ride rich in the region, Mercado Libre is poised to benefit from a growing middle class. Okay, in the first quarter, Mercado Libre's gross merchandise volume rose 43% year over year, which marks an acceleration from a quarter first and quarter fourth of 2022 with combined increase with a growing take rate. And you have a recipe for a company with strong pricing power. On the fintech side of its business, Mercado Libre operates the popular Mercado Pago platform, which allows its users to invest, make peer-to-peer payments on or purchase products online. In just 1 year, has grown its customer base from a 35.8 million to 44.5 million, a 24% increase. However, these clients are using the platform more as total transactions rose 72%, and total payment volume was up 96% in quarter first. and the stock is valued at historic lows, despite Mercado Libre's overall revenue growth clocking in at 35% for the quarter. The stock remains valued at the lowest level since the financial crisis of 2008 and 2009. For years, Mercado Libre averaged around mid-teens revenue growth, yet traded for 8 to 12 times sales. Now that the company is growing even faster, the stock trades for a lower valuation, which doesn't make sense. Furthermore, Wall Street analysts expect Mercado Libre's above average revenue growth to continue as they predict 28% growth for 2023 and 23% in 2024. In addition to Mercado Libre's revenue growth, it also becoming more profitable, with profit margins steadily rising over the past years. Okay, I did it really quickly. Um, Today is 2023, July 4th, and this is it for today, and I'm gonna see you tomorrow, okay? Bye bye, everybody.